Okay, hi everyone. Thank you for joining us and welcome to this DCF LLC webinar. Today we have Frank Keene, our DCF LLC fiscal agent, to present on the SBA 504 funding process, the small business window to Wall Street. Frank is responsible for coordinating the monthly sale of the debentures to fund the SBA 504 loans, and today he's going to give us all a closer look at what happens behind the scenes each month in order for your small business borrowers to receive their 504 loans. So we'll be taking questions throughout the webinar, and if you have anything that you'd like to ask, please just type your question into the chat box and submit them there, as all attendees will remain muted throughout the presentation. And then finally, I'd just like to add that this webinar is being recorded and we'll be making it available on the DCF LLC website in the next couple of days. So with that, Frank, thank you so much for being here. I'll hand it over to you and we can get started.
Thank you, Kim. Good afternoon or good morning to everyone based upon where you might be located. As the first slide reads, we're trying to provide a small business window to Wall Street for you to identify how the entire funding process takes place. In reality, we identify 3 days that really are important to us on the funding side, and that's just the announcement of the certifications of the certificates being sold, then the pricing date, and then the closing date, which is one that's most important to it all. Kim, I believe you have control over the slides, so if we can move on to the first display. This looks like it's more complicated than it really is, but what it identifies is the flow of loans, the flow of the loans becoming a note, the note becoming a debenture, the debenture becoming a certificate, the certificate being sold to investors, investors paying the underwriters for the certificates, the underwriters sending the funds to the fiscal agent who passes them back on to the central servicing agent, and the central servicing agent, the second box, the middle box on the right-hand side, Wells Fargo Corporate Trust Services, then sends the loan proceeds to the small business borrowers' banks. So it all starts with notes, and it's a question that people constantly ask, what's the difference between a note and a debenture and a certificate? In a sense, it's like talking about stocks and equities. They both mean the same thing, except they have different legal considerations. So your loan becomes a note, and that's where the Small Business Administration or the small business sends the notes to the CDC, and they then become debentures coming into the fiscal agent. I pass the debentures on to the underwriters. There's a document that's signed on funding date. It's called the Debenture Purchase and Pooling Agreement. And that's when the underwriters, with the help of the trustee, Bank of New York Mellon, convert the debentures to certificates. And the certificates are actually the securities that are traded in the secondary market, and those are the ones that are sold to investors and generate the funds for the program. Is there any question that anybody has about how this looks? Because what it does, it involves all the participants in the program. Myself as fiscal agent, yourselves as the certified development companies, Bank of New York Mellon as the trustee, the underwriters, Bank of America and Credit Suisse, plus the central servicing agent. And hidden in the background is also the bond counsel for the underwriters. If we can advance to the next page, Kim, unless there are any questions.
We don't have any questions, Frank. We do have a couple people saying that they're having difficulty hearing. I have my phone volume turned up and I can hear okay, but if you could try to speak up a little bit, maybe that will help the other listeners.
I will try to speak louder. It's on a landline and the volume is up to the max, so I'll speak up. If I start speaking too loud, just tell me to pipe down.
Perfect, thanks.
Here's the 504 Capital Markets team. As I mentioned on the previous slide, it identifies DCF LLC. Our purpose is to manage the funding process on behalf of yourselves and, in particular, the borrowers. And the purpose is to obtain the best monthly debenture rate available for borrowers. The underwriters are Credit Suisse and Bank of America Merrill Lynch. Bank of America, in its original form of Merrill Lynch, has been in the program since its inception in November 1986. Credit Suisse joined the program in 1994, replacing Citibank. At the time, Credit Suisse was known as First Boston. And their purpose is to market the certificates, sell them, also trade them in the secondary market. They do commit their capital to the program. They help with the assistance of the trustee, Bank of New York Mellon, to pool the debentures. They also provide product research, and they help post some of the charts that we do use on various displays during the course of the year. The issuing agent and trustee is Bank of New York Mellon. They, along with Colson Services, have been part of the program since its inception. Colson had been the central servicing agent until about 3 years ago when Wells Fargo Corporate Trust Services took over that responsibility. And everything starts with the central servicing agent as you process loans through them, and they, of course, make distribution of the sale proceeds. Legal counsel is Morgan Lewis, LLP, Morgan Lewis Bokius, LLP. After a merger last year, that is the new name of the firm. Prior to that, it was Bingham McCutcheon. Prior to Bingham McCutcheon, Brown Wood was part of the program from the inception. And they are the bond counsel primarily for the underwriters. They also assist me with several of my fiscal agent responsibilities. We can move on to the next slide. And what we've outlined here is the funding process with deadlines for the May 2015 sale, which is coming up next week. March 18th to April 1st is when you'll submit forms to Sacramento for no adverse change. They're then placed in a legal folder for district counsel review. And here's where the funding process kicks in, and these are the dates that are included in the funding calendar that we distribute with SBA approval in the fourth quarter of each year. The cutoff date, once you have district counsel approval, the documents go to the CSA for review and resolution of loan package errors. Monday, April the 27th, CSA sends CDC confirmation emails to the CDCs. And on Friday of this week, May the 1st, the CSA will provide me with preliminary loan numbers just so I have a sense of whether or not we're maintaining the trend of issuance that we have of late. Monday, the 4th of May, is the pulled loan deadline. CSA and the CDCs have resolved all loan documentation issues, and you're no longer allowed to pull a loan from the May offering. With that information in hand, the underwriters will have an official announcement of the May sale with final numbers. We'll talk about market conditions, market sentiment, the type of interest that we've seen, any changes that have taken place since last month when we priced at a debenture rate of 2.51, and then we get ready for the pricing date on Thursday. Once the underwriters have agreed to guarantee a pricing spread, whether or not they've sold all the securities or not, we then lock in that spread with them and investors, and at 10:30 in the morning on Thursday, May 7th, we'll price the securities. And then 5 business days later, on Wednesday, May the 13th, is the closing date. That's when the CSA will receive the sale proceeds from the underwriters and distribute the proceeds of the sale to either the borrower or the third-party lender. Okay, on to the next slide, Kim. What does 504 represent? Well, to investors, it represents the most important thing, and that is full faith and credit guarantee for the payment, the timely payment of principal and interest on the certificates that they're buying. So there are several guarantees that take place during this process, and various sections of the Small Business Investment Act cover them. Section 503 guarantees the full and timely debenture payments, and then again we're back to the stages: note, loan, debenture, certificate. So 503 guarantees the full and timely debenture payments, and that would be to the CDC. 504 section guarantees the full and timely payments to the DCPC holders, the actual investors. And what the funding process does, it provides monthly access to fixed-rate, long-term funding in the public capital markets, not otherwise available to small business. And I emphasize not otherwise available to small business because traditionally banks do not like to lend long-term at fixed rate. They much prefer floating rate, adjustable rate loans. This way, as rates rise, they can adjust the rate on the loan. Right now, we're in a position of almost a zero cost of funds to borrowers, for the banks rather. They're paying very low interest rates on deposits, and they're much more confident in extending long-term fixed-rate loans. And we've been in this cycle for a while. But the process also is it's a proven securitization process for 504, and it's appealing to investors, again, because there's a full faith and credit guarantee on the certificates. And we do have 28 years of history that have led to stable performance. We have over $63 billion in certificates that have been issued, and we currently have $27.1 billion outstanding.
We do have one question, Frank. Someone asked, they said that they're under the impression that the no adverse change cannot be done until the month of the cutoff submission date. Are you able to elaborate on that?
No, that's no. I'd be lying if I said I could. That's pretty much a procedural question that somebody in the office would be much better equipped to handle.
Okay, well, we'll take note of that.
No adverse change is a key consideration that, if you'll notice, that's also included in the commentary that goes out in the monthly fiscal agent letter. It's a very important consideration, but again, it would be something that would be more administrative rather than funding. So that's a question you might check on in-house.
Absolutely, we'll get back to it. Thanks. I'll proceed to the next slide.
Thank you. And here we have a history going back about 22 years to January of '93, where you can see where the trend is in both the black line going up with regards to a 12-month total, a rolling total of issuance, and this descending blue line reflects debenture rate with the rates on the left-hand side of the grid. This is a trend that we've tremendously benefited from, with some hiccups along the way, like in the late 90s, in 1999, for example, when we saw rates go from 5.5% to a 200 basis point increase to over 7.5%, and then begin a descent with one exception, and that was back in 2008. And you can see where rates spiked up, again, getting up to about 6.5%, and that was pretty much at the peak of the financial market crisis, where mortgage-backed securities created so much havoc in financial markets. From that period on, when the Federal Reserve Bank began its quantitative easing program and also its almost zero cost of funds, we've enjoyed a tremendous period of very low funding, capping it in December of 2012 with a debenture rate of 1.93%, which was the lowest we have in program history. On the other side, you can see where we've seen a big drop in issuance. The surge that took place in 2007 through 2009, and on a later slide, on slide 8, you're going to see the impact of all this issuance in 2007 to 2009, and then a dramatic drop. And the increase took place again starting in 2011, and the reason for that, since everything is connected, the reason for that was debt refinance. Debt refinance introduced about $2.25 billion worth of additional funding for the 504 program, and it's something that we certainly hope to get reinstated if all goes well. It's an issue that's of great benefit, not just to DCF in terms of funding activity, but also to borrowers, because the larger the issues we have, the more attractive they are to investors. Selling issues that are $250 million in size becomes somewhat restrictive because customers are also concerned about liquidity. So when we have issues that are $330 to $400 million in size, more accounts participate, and there's also a more robust secondary market that's provided. Any questions on the trends of issuance and also rates? Let's go on to slide 7, Kim. This is something that is available to all of you on the DCF website, accessing it through nadco.org. And it's the effective rate calculator. We'll talk more about this on a later slide, but this is a very important consideration. And the issue that we've highlighted here is the April issue, the 2.51% debenture rate that you see there. And randomly, we've selected a loan amount of $2,069,000, and you can then see the rates, the fees that are charged below that, the ongoing fees, not the upfront fees, which we don't figure into this calculator. If you haven't used this calculator before, I encourage all of you to take advantage of it, and also some of the other slides that are included on the NADCO and DCF websites. But this in particular is very important because it includes the CDC fee of 5/8 of a point, the borrower fee, which is the guarantee fee that SBA receives of basically 94 basis points, and the CSA fee, which Wells Fargo Corporate Trust Services is paid for acting as the central servicing agent. Right below that, the 2.51% debenture rate translates into a 2.55362% note rate. Now, this isn't an exact calculation. Part of the reason being this is an Excel spreadsheet. The effective rate that you work with each month is provided by the CSA, and that's because they have a mainframe computer to work with. The reason why they have to work with that and the Excel spreadsheet does not pick it up is because of the stub. The stub refers to the short first coupon payment. For example, the settlement date for this security was in the middle of the month of April. So the first 6-month coupon payment to the investor is only a 5.5-month period. That definitely affects the calculation of the note rate. That's why our calculation is usually about a basis point below what the effective rate is as established by the CSA. You'll also see in the middle columns under effective rates, first 5 years, second 5 years, third 5 years, and the fourth 5 years, then the full term. And just like the note rate, the full term rate of 4.58% is slightly below what the effective rate is as calculated by Wells Fargo, by about a basis point right now. In a higher interest rate environment, that rate differential will be wider. And you might ask, why is the rate increasing over the 4 or 5 year periods? The effective rate is calculated based upon the outstanding principal balance at the beginning of each 5-year cycle. As a result, that 2.51% debenture rate becomes an effective rate of a smaller outstanding principal balance every 5 years. And that's the main reason why the last 5 years, the fourth cycle of 5.78% is 138 basis points greater than the first 5-year cycle. We're employing the same rate, but on a smaller outstanding principal balance. That's what gives us the effective rate of 4.58%. So just like we have a loan that becomes a note, that becomes a debenture, that becomes a certificate, we've got debenture rate, note rate, effective rates. And the calculations are slightly different for all of them because as you go up that line from debenture to note rate to effective rate, we've got additional considerations and calculations. So same rate, smaller principal balance results in a higher effective rate just for that time period, though. Any questions on the effective rate calculator?
We did have a question, Frank. What is the difference between the note rate and the debenture rate, and how is the note rate calculated?
The interesting aspect of that is that the note rate is calculated. The reason there's a difference on it is because the debenture rate is working off a 6-month time frame. The securities, the certificates, are a 20-year maturity for the most part. We have 10-year and 20-year. Both of them, though, have 6-month payments for principal and interest. The note rate is calculated on a monthly basis. Your borrower is paying the loan, principal and interest, on a monthly basis. Where are the proceeds going for the next 5 months? They're held by the trustee, and they're held in a money market account for the benefit of the CDC. What that represents is a float that is paid to the CDC, I believe, on a semi-annual basis. At low interest rates, that float represents a very small amount of income, but in higher interest rate periods, it can be fairly significant, especially for an active CDC. So the note rate is simply because it's calculating it based upon monthly payments by the borrower. The debenture rate is being calculated on semi-annual payments.
Thank you. We got another question. Why does the rate change in 5-year increments?
You need to have an outstanding principal balance to calculate from. It would be very difficult to constantly change every calculation and the principal and amortization for the certificates if you're adjusting the outstanding principal balance every 6 months. So back at the inception of the program, it was determined that they'd use 5-year intervals for that calculation. Again, it transfers to what's being marketed. The securities market is best served with consistency, and as a result, it's best to provide specific details that investors know what they're going to receive. Other slides that we're going to get to will talk about prepayment penalties on the certificates, and why they're necessary is the same reason why it's necessary to have a block of years that you can calculate the outstanding principal balance to, rather than changing it every 6 months. The consistency of doing it and the consistency of what the cash flow might be to the investor.
Thank you, Frank.
That's been the default since the beginning of the program.
Great. Those are all the questions that we have now. Should I move to the next slide?
Yes, please. Two slides ago, we talked about the surge in issuance that we saw in 2007 through 2009. This chart shows the surge of accelerations that the program saw in 2009 and 2010 and 2011. It's broken down, I don't know how clear it is to you right now, but in single month, 3-month moving average, and also the black line right under 2% indicates the long-run average, what we assume to be the long-run average of accelerations or defaults for the program. So just as this was a hindrance for the program back in 2010 through 2011, it's now a benefit to the program because we're running at a rate that's below 1% on a monthly basis, running about 1.1% on an annualized basis. That's a very strong argument for the program, especially since this performance, this declining performance that was seen going back to the peak in early 2010, this declining performance of accelerations has been beneficial to us in that the program no longer is in need of subsidy. With the political mood in Congress that Claire can talk about more than I can, it's very important to know that there's no subsidy required. And that gives us the better bargaining position of discussing opportunities like debt refinance or even internal refinance with legislators. It's very important to consider how we can grow the program, and this performance on accelerations is a very strong argument, and it's a very strong positive argument for the program. Any questions on the accelerations that we're seeing?
We have a couple questions. The first is, what does CDR stand for?
Consistent default rate or constant default rate.
Okay, great.
You might see other names for it like constant prepayment rate. Constant prepayment rate would deal with voluntary prepays, and constant default rate would deal with accelerations.
Okay, great. And then another question, which may be going back to the slide on the rates, but the question reads, what do you make of CDCs expressing the effective rate as decreasing, given that total monthly payments go down for the borrower throughout?
Are we talking about how the nominal effective rate increases even though the payments decline? The payments by the borrower might be declining because he's making payments on a smaller outstanding principal balance because it's an amortizing note and the loan is amortizing. But as a percentage of the effective rate, it's increasing because he's paying the same original rate but on a smaller balance. I don't know if I'm making that clear or not, but it's the difference between the principal balance and the consistent rate that's being charged on those balances.
Okay. Another question, will the lower current CDR lead to a lower borrower fee?
It can. What might lead to you're talking about the guarantee fee from SBA. Is that addressing the 94 basis points?
Yes.
Okay. It's 50-50. When I talk to CDCs about that and they see the performance of accelerations, it's obviously very positive. So one thought is let's reduce that guarantee fee and make it more affordable for borrowers. The other argument is let's maintain that fee where it is now because it's manageable, especially at these low interest rates, and it also provides a cushion to SBA so that we're not getting into a period of needing subsidy again if we see a uptick in accelerations. It's a catch-22 as to determining what the best course of action is. If you go back in time and you look at the history, there was no guarantee fee charged before 1996. And I haven't got the rates in front of me, but from memory, they were as low as 12 basis points. And in fiscal year 2009, the guarantee fee was a donut. It was 0. And that was at a period when we saw an acceleration of accelerations. So at the worst possible time, SBA was denying itself that fee income when we saw a surge in accelerations. And just as you manage a loan portfolio in each CDC, SBA is managing a collective loan portfolio of all your loans. And when they look at what subsidy might be required or what guarantee fee is appropriate, they're projecting this, and they're projecting their portfolio at a certain level or growing. And right now, and again, I'm getting ahead of myself in regards to the slide sequence, but there's a slide you'll see in a few minutes that reflects voluntary prepays, and they don't hurt as much because SBA is not at risk on standing good on timely payment for the debenture. But they do hurt because they strip those loans out of SBA's portfolio, denying them that guarantee fee income for whatever that fiscal year rate was. So it was as low as 0 in 2009, and it gradually got built up to about 94 basis points in 2012, and it's held there since. My sense is that it will change because it's based upon a calculation. In fact, I think the guarantee fee for the 7A program changed by less than a basis point, which probably was very awkward because a lot of calculations are made based on the guarantee fee, and the change was minute, yet it had dramatic impact. So my sense is there will be a change to it. I don't know how dramatic it'll be, but it's not forthcoming right now.
Thank you.
Can everybody hear me better now?
And another question, Frank, what is the current default rate?
I'd have to pull up that report on my screen. The current default rate, we were under 1% for the month because I believe there was 15 million in accelerations. And I believe the annualized rate for us was about 1.1%. We'll be able to see that better when we advance a few more slides.
Okay, great.
But
Thanks.
you can see 1.1% and matched it up with 8% in January of 2010. So you can see how much it's improved, and you can see how that has helped eliminate the need for a subsidy.
And another question, is the reported default rate net of recoveries?
No, I don't believe so. This is information that I'd like to receive from SBA, and I'm actually having more conversations with the agency with the Office of Financial Assistance to get more detail from the trustee on prepayments. But they prefer to provide this information in very general terms, and it's an ongoing conversation. But my understanding is no, they are not. I think that's probably one of the look-backs that they have in time, because this is just a monthly report that comes into the trustee. It comes in, obviously, from the CSA. It comes into the CSA. The CSA passes the information on to the trustee, and I use the data that they provide to develop reports like this.
Okay, are you ready to move to the next slide?
We are. Here's the slide I was talking about. And I always say it looks very busy, and it is. But it's also very informative for us because it goes back 10 years, 11 years to January of 2005. And we'll start with the accelerations that we just talked about. And that's the greenish line over here on the side. And you can see that spike that we saw going up to the peak in 2010, near January, in the first quarter of 2010. And then the subsequent decline all the way down to where we are right now. And because this is not on my computer, I can't see what the actual display is, but you can see where it's right about 1.1%, right above 20 million. It's actually below 20 million, but it's dramatic improvement for that. So you've seen that trend, the dramatic increase from January of 2005, spiking in the first quarter, January or so of 2010, and now declining to levels under 20 million a month in 2015. The dark blue line is voluntary prepays. You can see when the accelerations were peaking in early 2010, the voluntary prepays were at an all-time low. And now they've reversed themselves. So now, if you look at the bottom right-hand corner, you see very low accelerations, and we have voluntary prepays that are upwards of 175 million a month, 180 million on this chart. And that is a negative for the program. So even though it's not a default, that SBA is not responsible for making good on the defaulted loan, it's still depriving them of revenue on their loan portfolio. The yellow line represents our 504 rate. The spike that we saw back in the last quarter of 2008 with rates of around 6.5%, looks like a bad EKG chart when you saw that spike go up, and then from that period on, we've seen a dramatic, consistent decline all the way down to the first quarter of 2013. And in 2013, the consensus in the market was rates are going to increase. We had priced with the lowest debenture rate in December 2012 at 193, and you can see where in January of 13 we're starting to see an increase, and then in mid-year rates spiked higher, and we were pricing above 4%. The reason for that were comments made by the then chairman of the Federal Reserve Bank, Ben Bernanke, that they were going to start considering ending their QE policy, their quantitative easing policy, where they were buying 75 billion securities a month to keep interest rates low, and that they were prepared to ending that policy and raising interest rates. And everybody was caught wrong-footed at that period of time. So there we are with a peak in rates somewhere in the fourth quarter of 2013, and we've had a steady decline ever since, to the point where we priced at 2.51% last month, and with rates slightly higher this month, we'd be looking at a rate somewhere around 5 to 8 basis points higher, so maybe about 256 to 259. But that's just an estimate. We're not going to be pricing this until next Thursday. But this is an interesting chart to see where there's always cause and effect, where you're looking at a very weak, shaky economy with a potential financial market collapse from 2008 through 2010, and the net impact it had on accelerations. And overall, the economy wasn't in terrible shape going into that period, so the voluntary prepays were not really accelerating, and especially because interest rates were higher. So you're not going to see voluntary prepays in a higher interest rate environment. As we've seen rates decline, we've seen borrowers take advantage of these declining rates, and that's what the impact has been on our voluntary prepays. So it's a tandem move, but the wild card to it is not just interest rates, but it's also economic conditions. And the economy right now is still the slowest recovery from a post-recession period since the Great Depression. So it's been 85 years since we've had an event like this with such a slow recovery. And even with positive growth like job growth, we're seeing very weak wage growth. We're seeing low inflation and low commodity prices. So things are almost stagnant when you look at it. That's one of the reasons why the Fed has not raised interest rates yet. Any questions on the trend for accelerations and voluntary prepays and our 504 rate?
I have a couple of rate questions for you, Frank.
Okay.
The first is CDCs are publishing different rates to the market. What is the proper rate to publish?
Well, the proper rate to publish is what you post as soon as we price. When you talk about what is the proper rate, are we talking about the note rate or the effective rate? If that's the question, then the rate to be posted is going to be wait until Wells Fargo posts those rates. The consideration is, and the use of the calculators is to provide a good indication of where the market is and what the rates are. But it's just to make you better informed while you wait for it, or being able to market it and identify, the approximate effective rate or the approximate note rate to the borrower pending the confirmation from Wells Fargo. And that confirmation, I think, usually comes into the office 1 day after our pricing. So it's not a very long delay. And it's something that should be utilized, but again, it should be utilized as an approximation. If you're going to be using official rates, it's always best to wait until Wells Fargo, and then the DCF office can post the rates on the website.
Correct. So for any of the attendees who missed it, earlier Frank went over how the effective rate calculators on the DCF LLC website are just used to estimate. So some CDCs do get the debenture rate and then use the calculator to estimate what the effective rates may be. But until the Wells Fargo Corporate Trust Services, the CSA, provides us with the official effective rates, anything published is just an estimate. So the official rates are always posted on the DCF website as soon as Wells Fargo provides them to us. And then
one of the things that we're going to change is that at 10:30 on Thursday morning, on the funding date, I price the debentures, the certificates, with the underwriters. I then have to email and call the contract officer at SBA and also the deputy chief in the Office of Finance at Treasury for their formal approval. During the course of the week, I'm notifying them of changes in the market, the size of the sale, and also what my estimate's going to be on the funding. And that email and that phone call confirm what the pricing is going to be. The information is then sent to the office, and Kim or Denise will then post it on the website as quickly as possible. And I then put out a pricing memorandum also to the contract officer at SBA. What I'm going to start doing is including the Treasury rate and the spread to Treasuries in the email to Kim, so that she's going to have all that information to get up on the website, so it'll be available shortly after the 10:30 pricing. So those are going to be the raw numbers for you. You'll see what the debenture rate is. You can then use the effective rate calculator to give you a strong approximation for what the effective rate will be to the borrower, because you can input the rate and also the loan amount, and it will also default to you what the approximate note rate will be for the borrower. In fact, we had to coordinate several phone calls last month with one CDC whose borrower had used an Excel spreadsheet to sort of back into what his interest rate was going to be. And you can't back into a rate like this because it doesn't take into consideration those 4 5-year periods of principal balance, and it doesn't take into consideration what the changes are in the amortization schedule for the loan and the certificate at that time. So there were several phone calls and spreadsheets that were exchanged to educate the CDC and the borrower on that. And the use of that calculator, the effective rate calculator on the website, was very helpful.
And one more question, Frank, in regard to the note rate. The question is the note rate an imputed number derived to mirror the debenture rate?
Is it an imputed number or what?
An imputed number derived to mirror the debenture rate.
It is. I mean, essentially, the note rate's it's a monthly pay equivalent of the debenture rate. The debenture is a 6-month security. The loan is a monthly pay. So it's a simple time value of money concept, but there's a sophisticated calculation behind it. Right now, the note rate is about 4 basis points above the debenture rate. In a higher interest rate environment, it could be as much as 8 basis points above.
Okay, thanks. Next slide.
Yes, please. Okay, you know what the characteristics of your loans are. Here are some characteristics of the development company participation certificates, and that's the full name for them, development company participation certificates. Say that in characteristics after it, and it becomes a tongue twister. So DCPCs exactly match the full amortization, interest rate, maturity, and prepayment penalty schedule of the pooled debentures. And that's all we're doing is we're pooling all the loans. The loans become the debentures become the certificates. And principal and interest is paid semi-annually. Principal and interest is paid by the borrower on a monthly basis. And again, that's a indication of why the note rate is different than the debenture rate. And it's also what represents the float to the CDC. The second item, the prepayment penalty schedule. It starts at 100% of the debenture interest rate and declines ratably to par after 5 years on a 10-year maturity or after 10 years on a 20-year maturity. So, for example, the April sale, 2015-20 Delta, it was a 2.51% rate with a maturity of 4/1/2035. And since there's a 10% penalty, the original prepayment price for the first year is 102.51. So that meant if it was a $100,000 loan and the borrower decided, I'm flush with cash, I don't want this 20-year debenture, I'm going to pay it off. Well, if he pays it off in the first year, he's going to have to pay $102,510. And that premium of $2,510 is distributed ratably to all the investors, distributed, as it says there, on a pro rata basis. And the acceleration of principal upon loan default is at par. So on a acceleration, the investor is paid off at par. And the security might be trading at a premium in the secondary market. And if the loan defaults, he's going to be paid off at par. So technically that's a loss to the investor. Conversely, if interest rates decline dramatically, then you're going to have these securities trading at a discount to par. You might be trading a dollar price of 95 instead of 102.5. And if that's the case and the loan defaults, then the investor is paid off at par. So he's reaping the benefit, the bonus of that 5-point differential. And reason why the prepayment penalty is so important to investors, they look at these securities and they measure their cash flow with the time frame for an investment. Everything is calculated to a specific schedule. Just like adhering to our funding calendar, investors adhere to a funding schedule and a duration schedule. They want to know how long an investment they're making. Our 20-year debenture, our 20-year certificate, actually has about an 8-year average life. And the reason for that is the payment of principal and interest, not just interest. Even on a 10-year bullet, something that has no amortization schedule, the average life is about 7.5 years. And the reason for that is interest is being paid every 6 months, and that interest goes towards reducing the length, the duration of the investment. So the attractive aspect of this is the obligation of the U.S. for risk weighting by investors. It requires less capital to be held in reserve, less leverage, more leverage for the investor actually, because they don't have to apply any reserves against a full faith and credit investment. Range of coupons for our issuance have gone from a high of 10.75% in October of '87, and that was again getting into that financial crisis that we saw in the previous charts, and the low of 193 in December of 2012. WAC stands for weighted average coupon. So if we average out that range from 1075 to 193, the weighted average coupon of all our issuance is under 5%. It's 4.98%. The outstanding weighted average coupon is less than that. It's 4.65, and that's just a reflection of the decline in interest rates that we've seen. And as I just mentioned, the projected average life on a new 20-year par pool is 8.02 years at 5% constant payment rate. We talked before about what does CDR stand for. It stands for constant default rate. CPR stands for constant payment rate. And that's what investors look at. They measure what speed the prepayments are taking. So if they see dramatic accelerations in all our prepayments and our voluntary prepays and accelerations, the speed might increase. And if the speed increases, you'll see a shrinkage in the actual duration or the average life of the pool. And that has an impact on investors' thinking and how they approach our certificates. Any questions on the characteristics for the investors?
No, sir.
Onward. And here's how we deal with pricing. And again, explanation of more rates. Nothing really trades on its own merit. Everything, even our performances are measured. My performance is measured by how well we fund against other characteristics, against other securities with similar characteristics. I'm rated by the principal manager for DCF. I'm rated by the contract officer at SBA. All of us, to some extent, are rated or viewed and analyzed in our performance. The only security that trades on a standalone basis without relative value is Treasury debt. U.S. Treasury bills, U.S. Treasury notes, and long-term 30-year U.S. Treasury bonds. They trade on a standalone basis representing the sovereign debt of the United States. Everything else, whether it's a high-grade corporate bond or an asset-backed security or development company participation certificates, trade on a relative value basis to all these treasuries. So when we set the debenture rate next Thursday, what we look at is where 10-year treasuries, since we're going to be pricing 10-year and 20-year certificates, we'll look at both 5-year and 10-year treasuries, but I'll focus on the 20-year. So we're going to look at the 10-year treasury rate, and then we're going to look at a swap rate. And all a swap rate refers to is interest rate swaps. Right now, we're at historically low interest rates. So if you were to bet, are rates going to rise or decline from this level? I think 99% of us would say rates are going to rise. So if you want to make a bet and you want to lock in paying something at a low rate to be compensated at a higher rate in the future, what you'd do is pay fixed and receive floating because you think rates are going to rise. If we were at a different level in rates, maybe instead of 10-year rates being at 197, maybe they're at 4%, you might think rates are going to decline. So if that's the case, you want to receive fixed and pay floating. So it's just an opinion on the market. And that opinion is expressed in a rate or in a spread that the principals that trade interest rate swaps charge. And right now, a 10-year swap is trading at around 8 basis points. So in here, we're using an example. In the pricing we had 2015 20A, which was the January issue. We're looking at 2.01% on the 10-year rate, and this shows you how little change we've had this year. This is January. In April, 10-year Treasury was trading at 192. Here they were at 201. So in January, the Treasury rate was 201. The swap rate or swap spread was 11 basis points. 11 basis points for the swap rate. So now you're up to 212, 2.12. And then the spread reflects what investors charged us for not being a full faith and credit product because we have an amortization schedule. So that sounds a little confusing because we are full faith and credit, but we haven't got a defined maturity. We have a 20-year maturity, but it's only got an 8-year average life. U.S. Treasuries, if they have a 20-year maturity, they've got a 20-year payment schedule. They get interest every 6 months and then principal at maturity. Our securities are paying investors principal with interest every 6 months, and that's what shortens the average life. And that's why we're charged that 40 basis point spread. So you have 201 is the Treasury rate, 11 basis points for the swap rate or swap spread. That brings it up to 2.12. And then the premium for pricing our structure is 40 basis points, giving us a total of 2.52%. So the swap rate, as I said before, is the Treasury yield plus the swap spread. And the 20-year 504 loan uses the 10-year swap rate. The 10-year 504 loan uses the 5-year swap rate because that's what the approximate duration is or average life is for the 10-year issue. And the pricing takes place after several conversations over a period of days and culminates on Thursday mornings at 10:30, when we've already agreed to what the spread should be, and we simply lock in the spread and the Treasury and interest rate swap rate at that particular time at 10:30. Any questions on what we do the day of the pricing?
We actually have a couple questions going back to the previous slide, Frank. A couple people are curious about who are the main investors or buyers of the 504 certificates.
And that's coming in another slide.
Great.
It's primarily money market accounts, insurance companies, and banks. But we'll see that in a slide or two.
Okay, great. We'll move forward.
And I mentioned before comparison. We're always measured in comparison to things. I can't see it that clearly here now, but we haven't got Treasury spread up here or Treasury rate up here. What I have is SBA. We're the dark blue line on the bottom, and right above us is a structure called Fannie Mae DUS, Designated Underwriting Syndicate. And it's somewhat similar to us because Fannie Mae is a government agency. They're not full faith and credit, but they're actually under custodianship of the Treasury. So it's as close as you can get. And you can see where they funded a spread, and this reflects spreads to Treasury, like I mentioned on the previous slide. So their spread is slightly wider than us. The yellow line reflects what a 30-year mortgage spread is to 10-year Treasuries. So that reflects a spread right now of about 170 basis points. As Kim's moving the cursor along that screen, you can see over on the right-hand side, that's about 170 over Treasuries. Down at the bottom, we're pricing at around 60 basis points over Treasuries. The light blue line is a single A CMBS security, that line that she's tracing right now. And you can see where that spread right now is about 210 basis points to Treasuries. And if we didn't have a full faith and credit guarantee, that's approximately where we'd be pricing. So you'd be looking at an additional 150 basis points being added on to your borrower's cost if we were not a full faith and credit guarantee. The line on the top reflects a BAA corporate, and that's yet even a lower credit. That's trading around 300 basis points over Treasuries. And all these spreads change. You can see where that line, none of these lines is straight. It's nothing linear about it. It all reflects changes in the market, sometimes more dramatic than others. And it all relates to credit. And one of the reasons why, even though we've had, ups and downs where we've seen spreads widen as much as getting out to about 80 basis points in 2012, and as low as probably 40 basis points in 2012 and 13, there's a certain normalcy, and again, it's because of the full faith and credit guarantee and the consistency of the program. What would be of additional benefit to us is seeing the program grow, something that all of you want to see, and I want to see it because investors want to see it. They like to have larger issues to invest in and trade. So it's benefit to all of us. But this is an indication of comparative spreads to Treasuries, and we do fund at the best spread of all companion issues. If no questions, Kim, we can move on to the next slide. Here we go. Who buys DCPCs, and why do they buy them? For different reasons. Insurance companies right now are very active. I track who the accounts are that buy the securities, and it's a way I can measure the performance of the underwriters to see how many accounts are participating in a sale. Like anything else, the more the merrier. You want competition. So each month we try to become oversubscribed on the sale. So we had 338 million certificates for sale last month. Those certificates are evenly split between the two underwriters. And each one had a subscription of about 1.25, meaning they had 125% in orders for the 100% of their allocation. And as much as that might sound good, it's not as good as it has been in the past, where we've had oversubscriptions of 2.5 times and 3 times. Ironically, some of those strong oversubscriptions took place when we had historically low interest rates. So sometimes you just can't figure this out. But insurance companies buy it for yield, safety, the government security status, and yield is very important because they're always looking to match their liabilities. Bank portfolios, again, look for yield, safety, government security status, and by and large, banks have to designate their investments, whether or not they're for trading or held to maturity. And they are not supposed to move the investments from one category to the next without penalty. So as a result, a lot of banks that buy these securities and put them in a hold for maturity, it reduces the secondary market liquidity for the securities. Money managers have become a more active part of our distribution, and they're buying on behalf of several other institutions. And their relative value, they're always looking at whether or not we're improving or widening in spread to other issues like I mentioned before, Fannie Mae DUS, single A, BAA securities. As far as what type of denominations we have, the minimum denomination on certificates is 25,000 with multiples of 1,000 thereafter. And regarding a typical sale, we had about 13 investors. Each underwriter had about 13 investors in last month's sale. So if you broke it down cleanly, each one of them had something like around 13 or 14 million as an allocation. But that, of course, isn't the case. Some accounts take down 30 or 40 million, others take down 1 or 2 million. So it's a blend of size, and it's a blend of types of investors. Any other questions on who buys DCPCs?
Nope.
Okay. And again, why do they buy them? Full faith and credit, the absolute yield, the spread over treasuries is very attractive, so it's a full faith and credit product with an added spread to treasuries. We have a consistent monthly offering calendar, a well-supported secondary market because the underwriters do commit capital to holding positions in the securities. The cash flows are predictable or reasonably predictable based upon what level of accelerations and voluntary prepays we're experiencing. And again, we have a 28-year history with rich prepayment and acceleration data. We can move on to the next slide, Kim. And where are we going? What's ahead of us? In December of 2012, actually into May of 13, we were poised for higher interest rates. Most projections were that 10-year treasuries in 2014 were going to be at 3%. And they weren't. And as we entered 2015, the expectation was we're hanging around 2%, but we're definitely going to end 2015 with 10-year treasuries yielding around 2.5 or 2.75%. And we're not. We're trading at 1.97. So until the global economy strengthens, the Fed is unlikely to raise rates because they don't want to get into a period where they start raising interest rates, tightening money, and then see job growth slow down and wage growth still not accelerate. Also, we're in a situation where there's a push-pull. There's always a push-pull dynamic. And right now we've got cheap gas, which is helping consumption, or should help consumption. It hasn't. People are saving more. Consumption represents 70% of the U.S. GDP. And we're dependent upon it for growth. So cheaper gas, cheaper commodity prices in general are doing battle with a strong dollar. So the strong dollar is hurting American exporters because the global economy is in worse shape than the U.S. economy. There'll be a revision tomorrow to first quarter GDP. It's expected to be around 1%. And even though projections for second, third, and fourth quarter GDP are higher, it's still 1% is far below the 3% ideal level that the Federal Reserve Bank is hoping to achieve. So we know the Fed needs to raise rates at some point, but they're very fearful of being premature. The challenge we have right now in the program is that banks have a zero cost of funds. So ordinarily they much prefer to issue adjustable rate loans, but with rates low and expectation for rates to stay low, they're much more comfortable issuing these long-term fixed-rate loans. What'll change is when we do see the Fed move, short-term rates rise, banks are looking at a higher cost of funds, less inclined to issue long-term fixed-rate loans, and CDCs see renewed demand for them. And what would be ideal is if now that we have zero subsidy, we can petition Congress for reinstatement of debt refi and possibly internal refi. It's estimated when we look at 175 or 180 million in voluntary prepays in April alone, it's assumed, I shouldn't say assumed, it's known that some amount of them are being refinanced in other SBA programs like 7A. And also 7A volume is a result of 7A borrowers being allowed to refinance in 7A. So we're at a handicap in this regard, and it's just another indication that it's a very cyclical program that we represent. And where we best perform is in a rising rate or a higher rate environment where we can provide 90% loan-to-value loans to borrowers with fixed-rate long-term costs. So that's our strength, and hopefully we do get to a point where the Fed starts raising rates because we're seeing stronger economic details. We're seeing some inflation because, yes, inflation is good for us, and we'll see more demand because the economy will continue to grow. And there's the plug for nadco.org, which leads you to the DCF LLC webpage, which is a great website that Heather McNellis developed a few months ago, and it provides a lot of historical data and resources and calculators that you should definitely use to your advantage. Kim, do you have any other questions or any other points that you want to address?
No, that's all, and we are just 1 minute over, so we'll go ahead and wrap it up. Thank you, Frank, so much for all of your knowledge that you've shared with us today, and thank you to everyone who's been on the call.
Thank you. Take care.
Have a great day.